Hello and welcome, everybody, to the quarterly conference call for Barber Financial Group. I'm Dean Barber, along with Bud Kasper, and the theme of today's conference call is going to be diversification is back. And we're going to talk about how last year's leaders are this year's laggers, and last year's laggers are this year's leaders. And Bud, you've got some statistics for our clients here on what's going on in the capital markets, and we'll do a little bit of history here, just what's happened in the second quarter or year to date so far here in 2015. And then we're going to get into some discussion about China, about Greece. We're going to talk about the Fed. We're going to talk about interest rates, and we're also going to talk about what we think all this means to your portfolios, what our plans are for the balance of the year and the coming quarter. So, Bud, let's just review a little bit of what happened here so far in the first half of the year.
Sure, Dean. Happy to do that. Well, this is our end of quarter review, and I titled it as I was preparing for our session today, Dean, halfway through the year, is it half full or half empty? And I think that's a fair statement because there's so many things that are going around the world. I love to pull out my 75-cent word, exogenous events going on around the world, both from a political perspective as well as economic. And, of course, all of them are joined at some particular point in time. But halfway through this year, stocks finished almost the same place that they started the year, Dean. By the end of June, the S&P 500 was up a mere 1.1%, and the Dow Jones was down 0.1%. However, small caps, mid caps fared very much better. Both were up around 4% at mid-year. The big winner, however, was foreign stocks, and that's based on the EFA index, and that was up 6.1% for the first 6 months of 2015. Now, we know that part of the reason for that is that the Central Bank of the European Union, and boy, we could spend a lot of time on that, in fact has established another quantitative easing program. So if you're not familiar with that, and you should be, this is a program that we started back in 2008 with the Federal Reserve, of where they ultimately ended up printing at the beginning stage $1.1 trillion and then used $40 billion of that per month in buying 30-year treasuries and 30-year agency bonds for the purpose of doing what? Keeping interest rates as low as possible. The benefactor of that was the stock market because you couldn't get reasonable returns anymore out of your savings accounts, CDs, etc. You had to reach out with to other places such as stocks that paid dividends, bonds, etc., etc. And it buoyed the stock market dramatically. We're in the third longest bull market in stock market history, now over 6 years. How long is the longest? It's 9 years. Could we see this go 9 years? I can't tell you that that's not out of the realm of possibilities. But for that to occur, Dean, in my opinion, it will only happen if we can sustain economic growth at targeted rates, which would be, based upon the Fed standard, somewhere around 2.5%, maybe 2.8%. I'll give you a rationale as to why corporations can continue to make money, and that should reflect back into this. Well, my point coming into this, Dean, is that in Europe, they took the exact same tack as we did over there in 2008 by announcing at the end of January a 1.1 trillion euro program. And starting on March the 9th of this year, they started pumping 60 billion euros per month into their bond market. And if we can draw a parallel to the success that the bond and stock market had in the United States during the quantitative easing period, which, remember, ended at midnight on Halloween last year, then what we are expecting is somewhat of a parallel over to the European stock market and perhaps in bonds. I'm a little reticent on the bonds, meaning I don't think that they're going to have the same response that we had here in the United States, but I think stocks, as demonstrated in the first half of the year, are doing so. Now, the one difference with this European quantitative easing is they're front-loading it. What does that mean? They're putting more money in the program at the beginning of the period as opposed to what we did, which was the same amount month after month after month after month.
Well, and, as we began this year, Bud, if you'll recall our end-of-year conference call, or, the conference call we did January of 2015, you and I both talked about the fact that we felt like Europe would institute a quantitative easing program similar to what the United States did. We thought it would be sometime in the first half of the year. We thought that when that happened, we would start to see the dollar rise in value versus the euro. We thought that we would see positive reactions in foreign markets. We also felt like that we would see some positive reactions in domestic markets. All of that occurred, and then, of course, You have this whole idea that the Fed is going to come in and raise interest rates sometime this year, and I think Las Vegas has given odds that 60% chance that it happens in September, and about 30% chance that it happens later in the year, and 10% chance that it happens first part of next year. But when the Fed raises rates, I don't think really is a big concern, and I want to address the Fed before
but it's going to draw a lot of headlines.
It'll draw a lot of headlines, but people have to understand that what the Fed is talking about raising rates on is not U.S. Treasuries. It's not raising the rates on mortgages. It's not raising the rates on corporate bonds. It's raising the rates on the overnight lending rate, right, which has been at or near zero.
Right.
So what this means is that's the rate that the Federal Reserve controls, is the overnight lending rate. And so if they raise that by 1/4 of a point, that doesn't immediately translate into a 1/4 of a point increase on the 10-year Treasury or the 30-year Treasury, or even on mortgage rates for that matter. In order for those rates to go up, those are all market-driven, and we have to start seeing velocity of money come back into play. And we've talked a little bit about that, but velocity of money is simply measured by how many times per year a dollar changes hands. We saw the velocity of money hit really an all-time high, a dollar changing hands nearly 3 times per year, and that was back in 1982. And if you think about what was happening at that point in time, you had the first baby boomer coming out of college in 1968, and for several years to follow, you had 76 million people entering into the workforce and buying houses and having babies and buying strollers and cars and furniture and appliances and things like that. So you had massive spending from a massive population that had never been in the workforce before. Today,
creating demand,
right? Mm-hmm. That's what caused the inflation of the late 70s and early 80s. It didn't have anything to do with Jimmy Carter. It was a massive population spending more money than had ever been spent before.
Might have had something to do with Billy.
It could have been Billy, yeah. But, the whole thing is, that was exacerbated through the personal credit cards. So people were not just spending the money that they were making, but they were actually borrowing money and spending. Our millennials are different. The kids that are between 18 and 34 today, they're different. They're not borrowing money. They're not getting married as young. They're not buying houses as young. They're waiting later for family formation years. And with that, coupled with the fact that the baby boomers are all now past their peak spending years, the youngest boomer's 51 this year, you've got that massive population, which is the boomers, which are saving for retirement and trying to pay down debt. And at the same time, you've got the millennial generations that's waiting longer to form families. And so consequently, our velocity of money, or how often money's changing hands, is down to about 1.3 times per year. So less than half of what the velocity of money was back in the late 70s, early 80s. That's what drives inflation. And we actually had a short presentation a couple of months ago via the internet that we showed how the velocity of money really is what is tied to the 10-year Treasury. And so until we start to see that velocity of money turn around, I don't think we see long-term yields really start to tick up very much. So whether the Fed raises rates or whether they don't, I think what the overall impact on the fixed income market's going to be is we're going to see more of a flattening of the yield curve. In other words, I think that the short end of the yield curve is going to come up. Well, I think the long end might go up a little bit, but I don't think it's going to go up substantially.
Yeah, and typically what people do at that time is they go into shorter maturity bonds where there's lower volatility, but there's been a lot of talk about using barbell strategies to still capture some higher return. But we know, and I'll illustrate this as well, that when the Federal Reserve does make the announcement that they are going to raise the Fed funds rate, that there's going to be redemptions in bond funds. I think everybody knows that, especially our clients. I want to back up just a moment, Dean, because I don't think I set up the European situation correctly, because they just didn't arbitrarily start a quantitative easing program. They were a whisper away of going into a deflationary cycle, and that is not something that you want as a nation, as a union, or as a country. And so therefore, in order to avoid that clutches, because once you get into it, it's difficult to get out. That's the reason they front-loaded the program, to kind of jump away, if you will, from that deflationary abyss, and be able to get enough liftoff from the gravity of that to be able to sustain future growth. I just needed to back up a little bit on that. So
and while you're on that, Bud, I want to talk about the front loading, and let's just give a little bit of factual data here on the quantitative easing here in the United States, because the quantitative easing here in the United States between QE1, QE2, Operation Twist, and QE3 was about $4 trillion total, right?
More, 443.
And the idea was to get that money to financial institutions, to then ultimately have those financial institutions go out and loan that money to the public to get it into the economy so that we could start moving things forward.
Sure.
Well, the problem is that we still have $2.7 trillion of that money sitting on reserves with the Fed because banks have not been able to loan it out because we've got tighter lending standards, and then we've got people that really aren't interested in borrowing money. Mm-hmm. So there still is a lot of that capital that was created through all of the quantitative easing programs that's still sitting there. It's still poised. It's still ready to be deployed into the economy. And so I think that, when people say, well, the Fed's out of bullets, they can't really do anything else, I think a lot of people are missing the fact that there is still substantial assets sitting on reserves. In fact, better than 50% of the entire quantitative easing program has not made it into the economy yet.
Yeah. And I think that's something that may change with the millennials starting to get to that age that I think they're actually going to be, as you stated before, in their formative years, meaning they're getting their families together. It's kind of been delayed for them. Actually, I think they're a very sensible generation because I think they've learned from the mistakes of the parents for so many people that put on more debt than they ever should have, but it was so easy.
Right.
And now that the boomers, are going in and saying, don't get yourself behind the eight ball with too much debt associated with this. And some of these poor kids are coming out here with these college loan debts that are going to, which is another reason that we haven't seen the formation of families earlier, because they have this debt load on top of them with what the college is and all that. Let's go back and let's talk about GDP for a moment, though, Dean, because when we looked at the first quarter, we only grew at 0.20%. Now, originally, we lost 0.20%. Originally, that number was 0.70. They usually have three different phases, the third one giving us the final number. The final number was minus 0.20. Now, that's not horrible because we had a lousy winter on the East Coast again, not as severe as what we had the year before, but certainly pockets, especially Boston. And when that happens, that simply means that a lot of business that normally would have found itself in the first quarter was postponed until the second quarter when transactions took place, deliveries were able to be on time. And in the process of that, our anticipation is, and we'll find this out in the next 3 weeks, is that second quarter GDP probably, I think, is going to come in, Dean, this is a guess, maybe 2.2%, somewhere in that. Now, if you parallel that to a year ago, where we lost 2.1% in the first quarter, but finished 4.6% positive in the second quarter, again, averaging those together does what? It really puts you back into the target range that the Federal Reserve has for the economy, which is going to be somewhere between 2.4 and 2.8%. So you have to believe, Dean, that Janet Yellen, chairman of the Federal Reserve, and company, meaning the Federal Open Market Committee that she chairs, believes that, in fact, the U.S. economy can sustain growth on its own with no more what I refer to as artificial stimulation from the quantitative easing packages. If that is true, if the training wheels are now off and this economy can sustain growth, then I'll give you a rational reason as to why the equity markets might be able to continue forward. As you've said so often, and I use this often, Dean, is about the seasons. Winter turns into spring, spring into summer, and summer into fall. So is the case of the markets as well. The one exception that we've had to that is the bond market. Because when we look at bonds specifically, the bond bull market started in September of 1981, and the 10-year at that time, you want to venture a guess?
15%.
Perfect, 15.84%. So that has been in place now, this bond bull market, for 3 decades. So when we look at this now, we have seen 1.63% is how low the 10-year got. Right now it's hovering around 2.3%. So it is not unexpected that the bull bond market has probably run its course. And so the question that all of our clients should be addressing to us is, do we still need bond exposure at this time? And a personal statement that I will make, yes, you do, but not to the extent that we've had in the past. And the types of bonds that should be utilized is very different than what you would use during the 30-year bull market.
Well, and let's let's really lay bonds out for what they are. Bonds always have been and always will be a stay-rich investment. A bear market in bonds is not like a bear market in stocks. It's not like there's a drawdown that's going to last forever and that you're never going to get your money back. Because bonds are they're issued at par, they mature at par, and you get a yield on them, right?
Yeah, par being you put in 1,000, you're going to get 1,000 back.
Right. It's just at the end of whatever the duration is, whatever
Correct.
the time frame is.
Right.
The point that I'm trying to make is that I think that bonds still are an integral part of the portfolio, the safe part of the portfolio, but I think your maturities need to be a little shorter, and I think that you also need to have some floating rate exposure inside of that bond portfolio as well. But the bond component of a portfolio is always the safe portion of the portfolio. And it doesn't mean it makes money every month or every quarter or even every year, but over time, that bond piece of the portfolio is really the ballast. It's what keeps your portfolio afloat because it's not going to melt away like what equity markets can do, as we witnessed in the early part of last decade plus 2007 and 8.
Right, and it does act as a non-correlated asset to stocks many times. And so if we just look at the first 5 months of this year, Dean, we had $75 billion that went into bonds, both taxable and tax-free. However, in June, we saw $17 billion pulling out. So the point that I want to make with this is that it's more than likely that we're going to see a continuation of draining of bond funds and ETFs, meaning people are going to start to leave them because they know when we finally get that announcement that there is going to be a reaction. To let you know how the mutual fund industry has been preparing for this, if we look at the last 6 months of last year, bond prices were higher at the end of the first 6 months of 2014 than they were at the end of the year. Now, I can give you a rational reason for that. Bond fund managers, knowing that when the Fed makes the announcement that they're going to raise rates and they're going to have to meet redemptions, which, by the way, they must legally meet, okay, then they're going to have to sell their bonds.
They're holding cash because they've already sold some bonds.
They sold the bonds in the last 6 months of last year, and, of course, what does that do? It takes away part of the return that they would have got off those higher instruments. So,
exactly.
So that's kind of where we are, and, of course, it's going to be headline after headline associated with that, no different than what we're seeing now, Dean, with Greece and China. And why don't you comment on that?
Well, before we do that, let's continue on our domestic markets here real quick because, you and I said at the beginning of the year that we felt like with the support of quantitative easing out of the way that we were going to see increased volatility in our domestic markets. That, in fact, has been exactly the case. We have definitely seen increased volatility. We also said that we thought that even with the increased volatility, we'd see positive returns in the equity market somewhere between 6 and 8%. I still think that is a very viable number. And if you look back to last year, if you go from January through October of last year, you were actually negative in U.S. equities while they finished up positive for the year in a pretty big way. So the returns in stocks never come in a straight line. But I do think that for the full year, we're going to wind up with a decent year, unless, of course, we have something that is a total outlier that comes in and blows something up. But as far as Greece and China goes, the whole thing with Greece, it's an issue of the stability of the European Union. It's the euro as a whole, because if Greece defaults, if Greece exits, then it could cause additional countries to exit the euro as well. I think that when the whole Greece deal was going on, we received a few phone calls, not too many, but the question was, well, what's going to happen? Do you think that Greece is going to default? Do you think they're going to reach a deal? And I said, it's really hard to tell. I thought that they would reach a deal. Of course they did. Whether this deal is going to be any better than the deal that was reached, 6 or 7 years ago when they were having the same problems? I don't know.
Well, I had told people as I was preparing for this, they said, I know Dean's going to come up and say, well, you said 5 years ago that Greece would no longer be in the European Union and there may not be a European Union.
Right.
And that still might end up being the truth out of this.
Well, we also said at that point, 5 years ago that we thought that the euro and the dollar would trade in parity with one another. Right. Yeah. And now we're at 110 on the euro versus the dollar. So, it's getting close.
Yeah. So I think ultimately we should be pleased that they came up with some sort of an agreement on Greece. The dismantling of Greece out of the union would have been had a direct effect and increased volatility for a while anyway. Would it have a big overall impact? No, but it puts a big dent in the armor of the European Union and suggest that perhaps the Union isn't as strong as what they had hoped it would be after a decade of being together.
And China, on the other hand, has got multiple problems. China's problems, I think, are as big, if not bigger, than Greece's, and I think that China's impact on the global economy is obviously much larger than Greece's. However, China being a communist country and China being a country where the majority of the GDP in China comes from government spending, opposite of the United States, it's hard to really make a prediction as to what's going to happen over there, because I think that the Chinese government will do everything that they can in order to continue to keep that economy propped up. The big fear in China is the real estate market, because the real estate market has been on a tear. The majority of the Chinese citizens' wealth is tied up in real estate. And, of course, if you haven't seen or read any of the articles about all of the vacant real estate in China, it is rampant. There are literally ghost cities, not cities that were lived in before, but cities that were built in anticipation of getting people off the farms and into the cities and getting them into factories and working and those types of things that haven't materialized. And so there's a lot of real estate out there today that is empty, and so I think it's going to put some pressure on Chinese real estate prices, and it could be similar to what happened to Japan.
Yeah, we don't. You can't artificially create cities and expect there not to be a ramification from that, because that was just money that put people to work effectively. So that money would come back in the system, hopefully in a different way. So I think we can conclude by basically saying that we think the stock market has a chance of, again, we'll repeat the number, somewhere between 6 and 8% this year. That is if earnings still are going to be coming in. We had a headline that came in the other day talking about the floundering four, and that was McDonald's, Google, Time Warner, and TripAdvisor, all members of the 500 who did not meet their earnings expectations. But we're still getting about 70%, maybe a little bit higher, that are hitting their earnings. Again, if the economy can continue to grow, even in the face of the possibility of the Federal Reserve raising rates, which we think will not dramatically affect stocks in a negative way, and if they do, it's going to be, I think, for a short period of time.
Short term, yeah.
Yeah, but then after that, I think we're back on the road. Now, you had mentioned before we started this report, Dean, that we were seeing some divergence inside the U.S. stock market itself in terms of where favorability is. You want to talk about that?
Sure. Well, we really saw a reversal from last year, and really for 2013 and 2014 both. The pendulum was stuck on large cap domestic stocks. And so if you didn't have overexposure to large cap domestic stocks in 13 and 14, you didn't keep up with the major indices, that being the S&P and the Dow.
Which is a large cap blend.
Right. So, but what's happening this year is quite different. If you looked in the rearview mirror and you said, well, gosh, I guess the S&P is the only place to be, and you just overloaded there, then, of course, you've missed the boat this year, because the S&P and the Dow are both lagging the mid-cap and the small-cap indices as well as the international indices, which is why we started talking about the fact that diversification is back. And, a diversified portfolio over time will typically keep up with the big indices, but we'll do it with less volatility.
Right.
Doesn't do it every single year. There will be years where you'll be outperformed, but there'll be years where you'll outperform those major indices with that diversified portfolio. But the big key with the diversification is you reduce the volatility or you reduce the overall risk.
That's right. Yeah, and remember, that's one of the things that we adhere to as your advisors, is to make sure that we understand the level of risk you're willing to accept. And by the way, that will change, but we won't know it changes unless you tell us, or we do the reviews and make sure we're tracking exactly the way you want your portfolio to behave.
And our quarterly indicator for third quarter is positive. Our long-term equity indicator still positive. We look at these things every single day. If changes need to be made, if we see any of those indicators that we follow going negative, we'll be taking decisive action for your portfolios. And, of course, we always look forward to talking to you, answering your questions. We're here to answer those questions. Give us a call anytime you want to. We look forward to seeing you in our offices. And thank you so much for joining us on today's conference call. We'll talk to you all soon.